Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you'll see future videos as well. So today we're going to dive into one of the I think tougher things to kind of wrap your head around and assess when you're looking at different companies in the stock market as prospective sort of investments, and that is deciding whether the management team is sort of on your side, whether their goals align with your goals, and they're the kind of person, they're the kind of jockey that you want kind of riding this racehorse that you're invested in. So I want to talk through some of both the qualitative and quantitative kind of things to look at. So some of the things we can put numbers on and some of the things we can't, basically. Management is also always one of those tricky ones where I feel like a lot of people that get into investing in the first place are very numbers oriented, and they do generally do pretty well with all the numbers that come across them and all these different financial ratios and that sort of thing. That may not be true for you, but I definitely found that true for myself personally, and I think that's fairly common for a lot of people that kind of drift towards the stock market investing world in the first place. But the management side of things and the people side of things is often a little bit trickier, just because there's not simple metrics that we can put on these people easily. So I want to dive into that, want to dive into some of the things I look at personally, and if you've got any other stuff that you look at as well, drop that in the comments below. Really keen to hear that. The more we can help out each other, the better the results we're all going to get. So that would be fantastic. Let's get into it. So I'm going to break this video down into 3 sections in terms of what to assess with the management team of a company you might be looking at. So the first thing is simply skill. Are they actually a good manager of this business? The second thing is integrity. Are they open? Are they honest? Are they going to tell us when problems come up and what they're doing about them? Or are they going to lie through their teeth and just try to recover before the next quarter and try to hide that in the numbers, and when they don't do it, we get a surprise. That's obviously not what we want. So skill, and then integrity. And the third one is incentives, which I think a lot of people kind of skim over quite quickly. Are the incentives of the managers aligned with the incentives of the shareholders, of the owners? Do they have a large personal shareholding in this business? Do they have some sort of, options, incentive contracts, return on equity incentives, all these types of things that align really well with the shareholders? Do these managers have that set up in place to align their goals as closely as possible with our goals as shareholders? So let's dive into those 3 sections and cover some things to look at. So I want to cover skill first. In a lot of ways I'm doing that because it's the easy one and it's one we can actually put a couple of numbers on. So is this person good at running the business? Do they generate high returns internally within this business? That's basically the question we're asking here. So there's a couple of key sort of financial metrics that I look at basically all the time when I'm looking to invest in a company. I probably mention them in just about every video, and that is return on equity and return on invested capital. So like I explained in the previous video, return on equity is simply looking at the net income generated from the business as a proportion of the total equity in that business. And that's going to often be displayed as a percentage. So you might see that the business makes a 5% or 10% or 20% return on equity. And the other one that's very similar is return on invested capital, which is almost the same thing, except this includes both equity and debt that is invested in the company. So it's looking at all of the capital that's funneled into this business and the return that's made relative to that invested capital. So long story short, if we've got a really good management team in place, we should be seeing above industry average returns on equity and returns on invested capital. And the reason I said above industry average is because I think a lot of investors fall into the trap of just using a simple number, just using a simple 10% return on equity or 10% return on invested capital cutoff. And although that's a good rule of thumb, I do genuinely think you have to compare it with in industries. So regardless of how good the management team is, there will be certain industries and certain businesses that have fundamental economic characteristics that stop that business earning a high return on equity. One of the really good examples of that is the business that I work in pretty much every day, which is agriculture and farming here in New Zealand. So farm businesses are terrible business if you were to look simply just on a return on equity or particularly return on invested capital basis. So farm prices have gotten quite high over the last 10-20 years. We've seen a lot of capital gain in terms of farm prices. We haven't seen as dramatic a gain in commodity prices. So milk prices and meat prices are still relatively constant. We've got some great lamb prices at the moment, but if we were to look at milk and dairy farms, for example, we haven't seen the milk price actually go up all that much. So although there's this idea of a lot of rich farmers and things in New Zealand, that's a fairly common sort of stereotype, I suppose. A lot of those businesses are relatively cash poor, so they have a lot of net worth. That can absolutely be true in a lot of cases, but that's almost always tied up in farmland, and unfortunately that farmland often doesn't generate a high return. So the typical return on equity that I saw in my region just this last week, the data came out, was right around 2.5% return on equity. So that is pretty terrible when you compare it to basically any other business. And it's one of the reasons I really want to emphasize that it does depend what business you're in as to whether, that return on equity number is good. So we see the really, really top performers, the best farmers in the country, making close to 10% returns on equity, whereas the average is around that 2, 3, 4% kind of range. And that's going to vary year to year with milk prices and other sorts of things. So, to be the absolute best farm in the country is getting 10%, and to have to use that as a benchmark or a minimum cutoff and say, oh, they're under 10%, they must be a poor manager, I think is a little bit naive. So I just wanted to put that one out there. Although the higher return on equity, the better, that it's not as simple as just saying if the return on equity is this figure, then they're a good manager. So that's my 2 cents on that. Return on equity is in a lot of ways like the interest rate on a savings account, I suppose. So it is a very, very important metric when you're looking into a business's fundamentals. But that's some notes on that. So if return on equity is high, that often gets the green light, particularly if it's higher than industry average. So if you've got a very capital intensive business, that number will probably be lower in general. If you've got a very minimal capital type business, a business that has a lot of goodwill and brand power, that will often generate much higher returns on equity, and that's actually one of the reasons that we see the likes of Warren Buffett kind of tend towards those businesses. So if return on equity is good, that's a tick. If return on invested capital is good, that's a tick. The only thing I would say is I would hope that those numbers aren't dramatically different. If you do see, for example, a return on invested capital of say 10% and a return on equity of 20%, that means that half of the capital invested is debt. So debt's something we'll get to a little bit later on, but in a perfect world, both return on equity and invested capital are high, and there's fairly minimal difference between the actual metrics because there's not a lot of debt involved in the business. So that's the first one around skill. Let's get on to integrity. So integrity, this is one of the points at which we struggle to use numbers in a lot of ways, and one of the points where it gets a lot trickier if you're very number oriented like myself. So there's a couple of things I look for with integrity. I do cheat a little bit and try to use some metrics here. So debt is one of the first things I look at, and this also flows over to probably skill and to having their incentives aligned with the shareholder. I don't want to see a lot of debt basically ever. There's businesses that will have a lot of debt just to be able to compete. So car businesses, for example, often have a lot of debt, even if that's just kind of short-term debt because they are a very capital-intensive business. Banks are always going to have a lot of debt pretty much. Several of them are very highly levered. It doesn't necessarily mean that's a dangerous thing. We saw it was a very dangerous thing back in 2008, but we see fantastic investors and investors very focused on risk and downside, like Warren Buffett and Charlie Munger, invested a lot in the banking industry. So I don't think debt is necessarily the worst thing in the world, but I would tend to steer clear of it in a perfect world and a perfect business that I was to invest into. So that's the next thing. In terms of integrity, the main other thing I look at is simply annual reports and communications to shareholders. So Warren Buffett is really the shining example, I would say, of integrity of managers in the investment world. A lot of people think of him just as an investor, but he is a CEO. He's been a CEO for a very long time, and he manages one of the biggest businesses in the world. So Warren Buffett puts out these fantastic letters every year, letters to shareholders, explaining the great things that are happening in the business, explaining the challenges that are happening in the business, and explaining where his thinking's at in terms of how he allocates capital. And he sort of writes about a couple of lessons every year. He tries to teach shareholders something about the businesses that he's in, and that's about as good as a shareholder letter gets. It's very honest, very open. If he's done something dumb that year, he will tell you he's done something dumb that year, and unfortunately that's very rare with other managers. But in a perfect world, like I say, that's the type of feedback that we're looking to get from CEOs, from CFOs, from the top managers at each of these businesses. So look for honesty. If they've made a mistake, I want to hear them say it, and I want to hear them talk about what they're going to do to rectify that mistake. I don't think we should shoot people down for making errors. That's the human condition. So, if they're open and honest about it, and we can make a good judgment of how that affects the business as shareholders, that's what I like to see in terms of integrity. So, bit of a tricky one, but that's kind of the second thing I tend to look at. So let's get into the last one. So the final thing that I tend to look at with the management team of a company is incentives. Are their incentives aligned with me as a shareholder? In other words, do they own a big chunk of stock in this company? Do they own, millions and millions of shares in this company? That is basically the ideal situation that I want to see. So there's a few different ways that managers are often incentivized. Options contracts are extremely popular now. And all these sort of incentive bonus pays and things. So those ones I'm a bit more skeptical on, to be honest, and I'll get into that in a sec. Straight up kind of share ownership is something that I really want to see. So oftentimes the best managers on the planet are going to be people that have either founded the company or been in the company a very, very long time, and are interested in the long-term success of that business. They're not necessarily too fussed about what the stock price does next month or next year. They want to fundamentally grow this business. They want to provide high returns on equity and invested capital, like I said. And they want to generate high returns for all shareholders. If they do that, they're going to get very rich personally if they're not already. And that's fantastic. That's exactly what we want to see. So a big shareholding is always great. The perfect CEO kind of incentive setup is basically a big personal shareholding in the company, really no short-term incentive pays, and that will probably surprise a lot of people. But that's basically what I want to see. I want to see the incentives of that CEO be exactly the same as mine. I don't have any incentive pays for this company that I own, other than the long-term growth of the stock, and dividends and buybacks and things that come my way as well. So that's ideally what I want to see. Just to touch on options contracts for a little bit. So if you don't know what an options contract is, from a management team perspective, basically as incentive pay, oftentimes CEOs get these contracts, and basically that contract is a right but not an obligation to buy into the stock at a certain strike price. So the strike price will be attached to the option. That strike price is what you're able to buy shares at, the price you can buy shares at in that business. So let's say you get an options contract for 100,000 shares at $50. That means that that CEO or that CFO or whoever it is can buy that number of shares at $50. So they have a lot of short-term incentives in that situation to try and have a really good quarter or a really good year, and have the stock price go to maybe 75 or 100. And if they can buy at 50 and it's currently valued or priced in the market at 100, they instantly double their money on that investment. So although it sounds very good in theory, it's definitely been abused, and it's one of those things that has incentivized a lot of kind of short-termism in management, I would say. Trying to get the price to temporarily go up so that they can get a big gap between the strike price and the market price. Although I like the idea of options, unfortunately some of the consequences haven't been great for long-term ownership. It's forced people to take out a lot of debt to try and inflate return on equity and grow faster than is potentially sustainable and all these things. So that's definitely one to watch out for. So those are my three kind of tidbits, I suppose, on management. So I hope you enjoyed it. I hope you got a lot out of it. If you did, hit like, hit subscribe, and you can watch previous videos over there or hit subscribe over that side. Pretty sure I actually got it the right way around that time. I might not have. You guys will see. And yeah, I'll see you in the next one. Cheers.